Welcome to the Deep Dive. Today, we're cutting through the noise and diving deep into Suzano's Q2 2025 results. You might have seen some mixed headlines for the quarter, but the market clearly found a lot to like in their strategic announcements.
That's right. Suzano's recent earnings call wasn't just about the numbers. It really painted a picture of a company making, well, decisive, forward-thinking moves to optimize its operations and future-proof its position. Even with dynamic pulp markets, these proactive steps resonated incredibly positively. We're going to unpack why.
Okay, so let's get straight to the numbers. On the surface, Suzano reported Q2 2025 GAAP EPS that's generally accepted accounting principles earnings per share on an ADR basis, basically how their shares trade in the U.S. of $0.26. That was a slight miss against consensus expectations. However, their revenue of $2.43 billion actually managed to beat expectations by about $109 billion.
Right. But if we look beyond the headline EPS, the underlying financials tell a much more robust story. Net revenue surged to $13,296 million, an impressive 16% increase year over year and 15% quarter over quarter.
Okay, wow.
Adjusted EBITDA, key measure of operational profitability, came in strong at $6,087 million. That's a 25% increase quarter over quarter, maintaining a very healthy 46% margin.
46%, that's solid.
Very solid. And significantly, they achieved a net income of $5,012 million, which is a powerful turnaround from a loss in Q2 2024.
Big swing.
Huge. They also generated robust operating cash of $4,149 million, and crucially, their leverage remained contained at 3.1x USD.
Right, 3.1x. And on the volume front?
Suzano shipped a total of 3,280 kilotons. That's 3.68 million metric tons of product. Pulp accounted for the vast majority at 3,269 kilotons, with paper making up the remaining 411 kilotons.
Got it. And pricing?
The average net pulp export price was $555 per ton.
Okay.
Though it's worth noting that China's hardwood pulp was a bit lower, closer to $500 per ton. And their pulp cash cost, excluding downtime, remained competitive at $832 per ton.
Okay. But beyond the raw numbers, what really captured the market's imagination were Suzano's bold strategic moves hinting at their future direction. Kicking things off, let's talk about the significant Eldorado Woodswap deal. How does this fit into their broader strategy?
Oh, this Eldorado Woodswap isn't just a clever deal. It's really a strategic masterclass in, capital-light resource optimization. Think of it like a savvy chess player, not just moving pieces, but looking 5 moves ahead to maximize every advantage.
Right.
Suzano will harvest 18 million cubic meters of Eldorado's mature wood between 2025 and 2027. In return, they'll give back the same volume of immature wood from 2028 to 2031, plus a cash payment of $1.317 billion spread across 2025 and 2026.
So they get the wood they need now, pay later with younger trees, plus some cash.
Exactly. This optimizes their forest management, dramatically reduces near-term wood acquisition costs, improves their logging radius, meaning shorter distances to transport wood, and helps them avoid significant future capital expenditures. Management expects an impressive internal rate of return, around 20% for this deal. That's a clear signal of long-term value creation without a massive upfront investment.
20% IRR, okay. And it's not just about cost savings, right? This Eldorado deal has a fascinating ripple effect, particularly concerning their Ribas mill. How does that connect?
Yeah, it's a fantastic synergy. They've discovered the Ribas mill actually has more sort of latent capacity than initially thought.
Oh, interesting.
Potentially allowing an additional 100 to 150 kilotons per year of production without any further investment.
Without capex.
Correct. So this wood swap, by securing and optimizing their wood supply, provides the optionality to leverage that hidden capacity. If market conditions become favorable enough to justify an increase in production, they can basically flip a switch, so to speak, and ramp up output. It gives them incredible flexibility.
That makes sense. Another move that really signaled a disciplined approach was their decision to curtail market pulp production. Why make that call?
Well, this isn't just a production cut. It's Suzano's bold move to reassert pricing power and prioritize profitability. They plan to run market pulp production approximately 3.5% below its nominal capacity for the next 12 months, which translates to a reduction of about 450,000 tons.
450,000 tons.
Yeah. This shows a clear commitment to disciplined capital allocation over simply chasing pure volume, especially when, as they highlighted, a substantial portion of global hardwood pulp production, around 15% or 7.4 million tons, is currently operating below its estimated marginal cash cost of $600 per ton,
Meaning they're losing money.
effectively losing money on every ton produced, and have been for 10 consecutive months. Suzano is saying, we're not going to contribute to an unsustainable market. It's about discipline.
Right. So we've covered how they're optimizing their forests and pulp production. What about their spending plans? We saw an adjustment to their capex guidance.
That's right. The 2025 capex guidance actually rose to our $13.3 billion.
Okay.
But it's important to understand this isn't due to a fundamental shift in their long-term capital intensity or some new mega project. It's largely attributed to the timing of the Eldorado Woodswap deal's cash payment.
Oh, okay. So it's related to that deal.
Exactly. Looking ahead, their goal for 2026 is actually to see capex trending lower, indicating a controlled spending outlook post-Ribas and post-Eldorado payments.
And what's the latest on the Kimberly-Clark joint venture? Is that still on track?
Progress is being made exactly as planned, seems like. Dedicated senior teams from both Suzano and Kimberly-Clark are actively working together, planning the carve-out. The target close for the operation is still mid-2026. And Suzano remains very confident in achieving the identified synergies of nearly $175 million in cost reduction opportunities from these assets.
Okay.
It's a significant value creation opportunity they're methodically pursuing.
Okay, let's shift gears a bit. The pulp market has certainly been quite a roller coaster recently. What were the key dynamics Suzano observed in Q2, and what's their outlook moving forward, especially with all these strategic adjustments?
Yeah, Q2 saw significant market disruptions, particularly in China. There were temporary halts in purchases due to their Liberation Day holiday.
Right.
This led to price corrections and an inventory buildup at main import hubs. Prices across Europe and North America kind of followed this downward trend. However, from mid-May onwards, there was a strong recovery in order intake, especially in China. July, in fact, saw exceptionally high order levels, even from integrated pulp and paper producers,
Interesting.
which strongly suggests a restocking movement is now well underway. This, combined with a recovery in Chinese paper and board production, has led to a reduction in pulp inventories at Chinese ports from their mid-June peaks.
So inventories coming down, demand picking up. What does Suzano see as the implications for pricing in this evolving environment?
Well, management believes current pulp prices, particularly around $500 per ton in Asia, are simply unsustainable for the vast majority of producers.
The $600 marginal cost point you mentioned.
Exactly. As we discussed, a large chunk of global capacity is operating at a loss. So in response to this more favorable demand outlook and these emerging supply constraints, Suzano has already announced a $20 per ton price increase for August sales orders in Asian markets, effective immediately.
Okay, so they're pushing prices up.
They are, and they're actively evaluating further upward pricing actions in other regions too. It signals their belief that, a floor has been found and prices need to move up.
With the market as dynamic as you describe, how challenging is it for them to maintain cost discipline? Are there any areas where they might struggle or where costs could rebound?
That's a crucial point, and actually they did quite well here. All cash cost components declined quarter over quarter in Q2.
It's declined. Okay.
Yeah, driven by stronger operational performance, the absence of major maintenance downtimes, and a reduction in the average logging radius at several operations, basically. They're sourcing wood more efficiently. They expect a continued downtrend in cash costs throughout the second half of 2025.
A downtrend, okay.
Supported further by lower wood costs and the startup of a new biomass power boiler in Aracris in Q4. Their goal is to enter 2026 with an even lower cost base than 2025, cementing their position as a low-cost producer. That's absolutely vital in this market.
Makes sense. Another trend Suzano is championing is this fiber-to-fiber transition. What exactly does that mean, and why is it significant for them?
Right, it's an important long-term strategic shift. Suzano sees itself as a protagonist in this movement. Essentially, they're helping customers transition from using virgin fossil-based fibers to sustainable, renewable wood fibers in their products.
Okay.
There's significant customer engagement globally, with projects being actively deployed, and the high and widening spread between softwood and hardwood pulp, which is expected to widen even further, directly benefits Suzano. This is because hardwood is projected to gain over 1 percentage point of market share over softwood this year. It's been a consistent trend for the last 3 years.
So they benefit as a major hardwood producer.
Exactly. Suzano stands to gain significantly from this shift towards more sustainable, cost-effective fiber solutions.
Okay, let's turn to their paper and packaging segment, especially given the recent news on U.S. tariffs. How are they navigating that?
Well, the Brazilian operations saw stronger sales volumes and lower costs, leading to EBITDA growth for this segment. Pretty good there. U.S. operations, while impacted by planned annual maintenance at the Pine Bluff mill in Q2, are expected to deliver positive EBITDA in Q3.
Back in the black for Q3.
Yeah, driven by lower costs and a higher production and sales volumes, as no maintenance downtimes are scheduled. They're also strategically expanding their market reach in the U.S., moving into new areas like food service. Their cup stock sales, for example, grew almost 200% year-over-year.
Wow.
And contractual price increases for their packaging products are set to take effect in the second half of 2025.
Okay, so the paper side looks pretty solid, but how are those new U.S. tariffs affecting them directly? Are they feeling the pain?
Thankfully, no, not really on the pulp side. Pulp exports from Brazil to the U.S. are entirely exempt from the new 50% tariff.
Exempt from the big one, okay.
Which is a significant relief for Suzano given their long-term commitments with U.S. tissue producers. Even better, Suzano has successfully negotiated with U.S. customers to bear the 10% tariff on pulp exports.
So Suzano isn't paying that 10%?
Correct. Suzano itself will not incur this burden. This really demonstrates strong customer relationships and, frankly, their market power.
That's impressive negotiation. What about paper exports? Are they impacted at all?
Some paper items are indeed included in the tariff, but the exposure is deemed immaterial.
Meaning it's small.
Yeah, a very small portion of their business. And to mitigate any potential impact, Suzano has proactively built inventories in the U.S., sufficient to cover sales through year-end. They also plan to redirect the majority of their U.S. paper exports to other regions, as the U.S. accounts for only about 20% of their total paper exports. So they have contingencies in place.
Seems like they've got the tariff situation well managed. So with all these strategic moves and a sharp focus on operational efficiency, how is Suzano thinking about its balance sheet and shareholder returns?
Deleveraging remains a clear primary focus for the company. That came through loud and clear. While net debt stayed relatively stable at $13 billion, and leverage ticked up slightly to 3.1x USD from 3.0x last quarter.
Just a small tick up.
Yeah, very small. Management highlighted a healthy amortization schedule and a solid cash position that covers their obligations for the next 3 years. Regarding shareholder returns, they will adhere to their established dividend policy, which is a minimum of 25% of profits or 10% of operating cash flow generation.
Okay, so dividends are still on the table, per the policy.
Right. However, they currently have a, let's say, lower appetite for share buybacks at this time.
Lower appetite, meaning they're not keen on buybacks right now.
Pretty much. They prefer instead to focus intensely on strengthening the balance sheet and enhancing competitiveness, deleveraging first.
Makes sense. So despite what appeared to be a mixed Q2 headline on paper, the market reacted quite positively to Suzano's call. What's the key takeaway for you, our listener here?
I think the positive market reception truly underscores confidence in Suzano's disciplined capital allocation and strategic foresight. That's the main thing. Even with some pricing pressures in the quarter, the company demonstrated strong cash generation and articulated a clear plan to enhance competitiveness, optimize its asset portfolio through deals like the Eldorado Woodswap, and control costs effectively.
Yeah, the Eldorado deal and the Ribas optionality really stood out.
Absolutely. And the announced production curtailment signals a mature, disciplined approach to supply management, aiming to protect returns rather than simply chasing volume. Then you add in the recovery signals in China, coupled with the long-term benefits of the Eldorado swap and the potential for increased Ribas capacity. It provides a cautiously constructive outlook. And management's prompt clarification to the CVM Brazil's securities regulator regarding the IRR and Ribas capacity not being new guidance also shows transparency without dampening the overall positive sentiment.
Right, managing expectations carefully. Okay, now for our segment that is explicitly not financial advice, think of this as a pitch to an investment committee. Our expert has a couple of wild yet plausible trade ideas based on today's call.
All right, investors, let's talk Suzano. Given the surprisingly strong market reaction to what was on paper a mixed quarter and those underlying bullish signals for pulp pricing, here's a thought, maybe two. First, consider the Ribas riser bull call spread. You could look at buying, say, a December 2025 SUZ call option with a strike price slightly above current levels, maybe $11.
Okay.
And simultaneously selling a higher strike call, perhaps $13, for the same expiry.
So limiting the upside, but reducing the cost.
Exactly. The rationale is this. Management clarified the Ribas optionality that 150 kiloton per year increase without capex. While it's not official guidance, this hidden capacity can be unleashed swiftly if pulp prices rebound meaningfully, maybe above, say, $600 per ton.
Right.
This call spread capitalizes on a moderate upside from a sustained pulp price recovery, leveraging that latent Ribas capacity without taking on excessive risk. The positive sentiment around earnings suggests the market is maybe pricing this in a bit. If that unsustainable economic environment for high-cost producers truly forces widespread cuts, Suzano, low cost and with potential incremental volume, is perfectly positioned.
Okay, that's idea one. What's the second?
Second, a bit more exotic, the tariff turbo iron condor on European pulp futures.
Iron condor, okay.
With Suzano explicitly saying they're redirecting U.S. paper exports to other regions, and their pulp customers bearing the 10% tariff, it suggests a potential tightening of supply in ex-China markets as U.S. demand shifts.
Okay, ripple effect.
Right. Coupled with the softwood to hardwood substitution trend, this could create a sweet spot for European hardwood pulp prices. An iron condor on European hardwood pulp futures, like IC futures, Europe NBSK pulp futures, could capture this. You'd sell an out-of-the-money call and put spread while buying further out-of-the-money protective calls and puts.
Betting on contained volatility.
Exactly. The expectation here is that European prices will stabilize or see a modest uptick, but not a dramatic surge or collapse, as global supply rebalances from U.S. tariffs and high-cost producer pressure. It capitalizes on relatively contained volatility and maybe a subtle upward bias in European hardwood pulp.
Just to reiterate, folks, this is absolutely not financial advice. All investment decisions should be made with careful consideration of your own financial situation and after consulting with a qualified financial professional. These are just thought experiments. Okay, that wraps up our deep dive into Suzano's Q2 2025 earnings call. What really stands out to you from this discussion? For me, it's clear that Suzano is actively managing its cost base, strategically optimizing its asset portfolio through these innovative deals, and showing real discipline in production to protect its returns.
Indeed. While the market environment remains dynamic, Suzano appears exceptionally well prepared to navigate these complexities. Their focus on competitiveness, deleveraging, and just disciplined execution of core operations and strategic initiatives. It positions them strongly for whatever lies ahead.
And mark your calendars. Suzano's Investor Day is coming up on December 11th, a date to keep in mind for further insights into their long-term vision. Thank you for joining us on the Deep Dive.
Always a pleasure. And we encourage you, the listener, to maybe consider how these strategic moves by Suzano might not just impact their own bottom line, but can truly influence the broader pulp and paper industry in the coming quarters. It's a big player making big moves.
We'll be back soon with another deep dive into the latest earnings calls. Until then, stay informed and think critically.